Hey everybody, this is Jose Blasco. We are about to start a sound check. As always, before we start the sessions, please go ahead and type a quick message on the chat box, just a quick hello would do, so I know that you hear me well and we are ready to get started. Please, let's do that. We just have around 30 plus seconds to go, so perfect time to do that. Very good. Very, very nice. Thank you so much for confirming all of this, my friends. I will turn on the video stream as well as always, so we can be connected. Hey, how are you, everybody, from the bottom right corner of the screen? Thank you, Joe, Clive. How are you, my friends? Everyone else, this is great. Let's begin, my friends. This is September 2, 2021. My name is Jose Blasco, Options with Options. I am highlighting the disclaimer on the screen so you can read it carefully. This is important information. Please do not skip it and read it carefully indeed. And we are about to start the session. So again, the session, it's about trading options, as the name of the session suggests. Most of you that are joining me in a regular basis, of course, you know it. That's why you're here, because you are hungry for options. For the ones of you that are newer to the sessions, so just so you know, we're going to look at the market environment. Then we're going to review the trades that we have. We're going to manage trades that may be open and need management. And from there, we'll move into finding new opportunities with the beauty of options trading, which is the fact that we can really adapt to market conditions, up, down, sideways, high volatility, low volatility, etc. Long story short, options give us options, isn't it? Very good. So I'm just going to move into the platform and begin. So here we go. Let me see chat box again. How are you, team? Good to see you in the session with us here. Wonderful. And by the way, a bunch of you are started utilizing top, and I would not be surprised, and I'm sure this is happening because it's normal. When you start using a new software, you may have questions. So please feel free to type them in the chat box, okay? And I will find ways to answer all those questions during the sessions. Maybe during the trade, maybe before or after, or between trades, depending on the nature of the question. But don't keep the questions for yourself. And while we are delighted to receive your emails and respond to your emails, I think it's probably a more efficient way as well, since we are connected, that if you have your questions, you just put them out there on the chat box. Okay, so don't be shy, please. It's not really need to say for me, because you guys are always there, and no need to mention. But at the same time, I know some of you are kind of like in that exploration mode, and again, I can maybe save you a little bit of time if you ask the questions that are in your mind, okay? And maybe I can guide you into what to look at or what to practice, okay? Good. Mario, good to see you. Ahmed, good to see you. Very nice. Okay, good. So I'm just checking all the chat boxes. Everything seems to be okay. So my friends, let's begin. Okay, so what do we have in here? Well, we have the S&P, okay? S&P ETF, SPY. When we look at the 55-minute time frame of that ETF, or no matter the time frame, we look at the performance, the market is up by 0.37% today compared to yesterday, okay? And yesterday we talked about the serious possibility for the market to start turning down, and not only it did not happen, the market kept going, okay? And this is the type of thing that we cannot underestimate and be too opinionated about things. We need to work on in terms of probabilities, and then with hedges in case we are wrong, okay? Yesterday I was very much pretty strong with my views when it comes to the market is likely going to start going down. It didn't happen, okay? Now look at what's happening, okay? So we have an ATR spread today of 103, okay? Statistics suggest that if we surpass 1.02, we are stepping into the territory which is 2 standard deviation, which means that 95% of the times this happens, then the market change climate from blue to red. So again, if yesterday I was mentioning that the market may turn and fall, today even more, okay? Now, when looking at the portfolio, yesterday we did get filled on ADM, which is our hedging trade, with a negative 30 plus delta, okay? So what's happening since the market gapped up and continued going higher? So this trade is losing $22. But what happening to the other trades? Well, they're making money, okay, and therefore overall the portfolio is making money, which this is exactly what we're shooting for. We are shooting for stability on the results. That's why even if you enter a hedge and it doesn't work according to plan, it's still good. Actually, it's kind of better because normally you don't hedge the whole portfolio, you hedge a percentage of it, and therefore it means that the other stocks are supposed to be doing okay. Okay. Also, when you look at the performance of Intel, I'll look at this more in depth in a minute. But remember, even though it shows as minus 11.5, actually that's a positive number because we already closed some profit. So again, you got two profitable trades against one tiny loss. Okay, so this is exactly what we should be doing to protect our accounts. Okay, let me take a look at Siderman. How are you, Siderman? Good to see you. Okay, so let's continue. Let's continue here with the analysis that we are doing. So again, climate 9 out of 6. This is indeed hopeful. Standard deviation 1.02 represents when the market, it's reaching that extreme, and we are surpassing that as we speak. So again, we also see the puts greater than the calls. So all of these basically confirms the very same thing that we discussed yesterday. Okay, now today I am not concerned because I got my hedge in place. So if the market continues going higher, great. If the market starts falling, the hedge will help. So I'm fine. So today what I would like to do is I would like to get into finding non-directional trades. Yesterday I talked about putting together some iron condor. So we'll do that. But again, if I didn't have the hedge, then the first thing I would do today is to look for a short, okay, to protect my portfolio given the risk. Okay, so you always want to be ready to act on whatever risk may end up showing up in the marketplace. At the same time, you don't want that situation to bias you, and next thing you know, you start closing longs, you start getting too many shorts in place, fighting the overall trend of the markets. So we don't want to do that. Okay, remember, I differentiate, and I insist many times, and I'm doing it right now. I differentiate very much into the main trades of your portfolio, which is what is supposed to produce your bread and butter profits, versus the hedging trades that we throw in there from time to time when there is risk, to protect that overall portfolio, at least in a percentage basis. Okay, so let's not get confused with those trades. Okay, because sometimes there are some trades that we like to enter. Those are the hedging trades where it's not like we like to lose with those trades, but actually the best thing that could happen is that those trades lose, because that means all the other trades are profiting. Okay, so again, keep that in mind. Separate in your thinking, in your trading plans, in your portfolio management rules. Separate what is it that is the trades that are my bread and butter, what drives my profitability, versus the trades that I add to protect myself in case something happens. Okay, those are the hedging trades. Okay, so don't get confused. And when I have a strong comment about the market condition right now, like I did yesterday or today, make sure that doesn't bias you. What this needs to do is trigger the need for, hey, I may need to hedge my portfolio, but that should not bias you into, now let's go ahead and short everything that moves, right? And close everything that was long. No, because the overall trend in the markets are up. So we are running a portfolio to the upside while we are protecting the downside with hedges. Okay. How are you, Maka? Good to see you. So anyway, so this is what we have when it comes to looking at the S&P, and when looking at the VIX. Very similar to yesterday, 1598. Yesterday was 16 point something, so it's about the same. Now the only difference is that now there is a red UFO there, which is likely going to bring the volatility a bit lower. That makes it extra convenient to start the session today with building iron condors, because if we build iron condors and during the life of the trade the implied volatility drops, those iron condors are supposed to perform better. So we will indeed explore that. Now, before we get into finding new trades, which I just said we're gonna explore iron condors, I would like to review the positions that we have in the account. I'm gonna do this by basing it on the midpoint. Okay, and if I base it on the midpoint, if First Solar is performing at a rate of $89. On the TOS account, it shows 85. Of course, there are a little bit of differences on how those values are calculated, but it's about the same. So again, the market pushed, and First Solar, seems to be pushing as well. Okay, so First Solar. Okay, First Solar is up 1.5% today. A UFO is showing up here. So this is looking a little better than the past days, isn't it? Okay. We also had an indication of an Elliott wave turning point, funnily enough, with a target around 102, which is our target. Okay. So all of this is indeed very good for our trades too. Hopefully this time continue its progression towards the target, where it's been a little bit of a teaser with a very strong move at the beginning, and then a little bit disappointment, then hope building up, disappointment, hope building up. Well, let's see what happens now, right? And again, those emotions have to be under control, okay? And hope means nothing for a trader. We just apply rules. So talking about rules, okay, today First Solar is 1.5% higher than yesterday. So today maybe we can go ahead and tweak it to lock in some profits. Okay, so let's take a look. First, Mario's question. Mario said, hello, Jose. For a bearish strategy, we select scan number 1, top negative CIV spread. Well, yeah. So if you don't mind, Mario, I'm going to be reviewing a little bit of the rules for the matrix today. So I will answer your question in just a moment, if you don't mind, instead of doing it now and having a little bit of a side conversation. Actually, I plan to do that. A couple of you asked me on emails as well. You started using top and you wanted me to review how to put the rules in place for the matrix. So I am going to review that in a moment, Mario, even though it looks like you have summarized it correctly, but let me review it in a moment. So we are looking at First Solar. Again, yesterday we tried to convert this bull call spread into a directional butterfly. So let's take a look at this today. We're going to load a race graph like we did yesterday. Okay, and remember that what we did is to compare spreads, so and copy the primary spread. So now I have two trades, same trade, in blue and orange color, and what we did yesterday was to add additional options legs. Okay, in this case, I'm gonna buy the 115 call with the midpoint. Okay, this would emulate and simulate closing the 115 call. Okay, so this is trade number 1. I would like to explore what happens if I close this trade now. Okay, so if I close this trade now, well, I believe this is exactly the same price we got yesterday. So it's interesting to see. We get 42 cents to close that one. So closing the call would end up providing a profit because you sold it at 91, you close it at 42. So that would provide a little bit of a profit. Okay, so that's okay. But then the question is, okay, if I was to do that, what else can I do? Because if you just do that and that's it, you went from a $489 risk trade, the one which is blue, to $580 risk trade, the one that is orange. Okay, and therefore, yeah, you closed a little bit of profit, but then you added risk. We don't want to add risk. We want to remove risk if we are tweaking the trades. We never want to add risk. Okay, we want to do whatever we do, always need to reduce risk. If it doesn't, we don't do it. So what else can we do then? Well, what I was exploring yesterday was selling an option higher than that. Yesterday we saw the next strike, I believe, was 120. Let me take a look. Yes, correct, 120. So what if I was to sell 2 of the 120? Okay, so if I sell 2 of the 120, yesterday we had no liquidity on the 120. Let's take a look at today. Today is much better, 23 to 28. Okay, 23 to 28. This is much better. Okay, so this is indeed better, which is what I told you yesterday, right? Yesterday, because the stock was a bit lower, that 120 strike was far away and therefore was lacking on liquidity, and the bid-ask spread was wide. Where today the stock gapped and moved 1.5% higher, and therefore what happens to the 120 call? Well, now it's more adequate for us to trade with a narrower bid-ask spread. Okay, so this is something that I would be keen on exploring. Okay, but again, if I do the trade the way I did it right now, which is, remember, I got the 115 call and then I buy it back, so this is like this doesn't exist. So if I have and sell 2 of the 120, so this is a ratio spread, technically speaking, is a call ratio spread, and therefore I am net short 1 call. And being net short 1 call is a problem, okay, is a problem because you cannot execute that in certain accounts. And if the stock was to move very fast to the upside. I mean, it needs to move very fast past 120. But if that was to happen, you may end up giving up money to the market. Okay, so it's indeed recommended to add one more call against that whole setup. Okay, which is going to be a buy one. Okay, and typically what you want to do is look at the distance between 120 and 92 and a half. Okay, and that distance is 27.5, so you add that on top of 120, and that would put you at 147, which probably is going to be 150. So let's take a look at the one. No, there is no 150, so it would be 140 is the further strike available. So if I do 140, okay, so that would be now a directional butterfly, which has a total risk of 492. Okay, 492 is the total risk of this. Sorry, the cost is 492, but the total risk is 542, which again is more than 489. Okay, so in other words, it is not really worth it to do the change yet. Okay, it's not really worth it yet. Notice that the risk profile is very similar. So we have this pennant, orange color and blue color, which kind of coincide, and even the dotted line, which is the real-time line, it's very similar. Remember, our target is 102. So more or less here, okay, more or less here. So if I get the data window and I put my mouse around 102, something like that. So notice how the performance of those two trades are very similar, both today and on expiration date. Okay, very similar value. The orange values and the blue values are very similar. So in other words, the trade is kind of valid to convert it, but I'm adding risk. Okay, so if I was to do this and my risk is diminished and my performance is similar, then I would be happy to do it. So we are in the same situation we were, I believe it was 2 weeks ago, when we tried to do the conversion and it was not fully worth it. So today it's a bit of the same story. It's not worth it to do it right now. Now, if that stock, if First Solar keeps going higher, maybe it rallies another 1%, 2%, gets to 97, something like that. So probably now it will be worth it to do. But again, we don't know. For now, we need to keep watching it, okay? Cool. So almost, okay, but no management to be applied to First Solar. So for now, we leave it alone. And I'm going to get into Intel. That's going to be a quick conversation. Please give me confirmation that you are with me on First Solar. Okay, quick confirmation. You are with me on First Solar. Cool. So, is there a quick check one can do to see when it is time to convert a bull call directional butterfly? Yeah, the quick check is what I've done, Tim. You need to simulate it and basically look at parameters such as the risk to see if you have the green light to do it, which, yeah, it depends on multiple aspects, okay? It depends on has the stock moved enough, time passing will also decay the call you sold, how much time has passed is another variable. What about the volatility? Has the volatility remained constant, when higher, when lower? This will also have an impact on being worth it or not, including the fact that sometimes your strikes won't be liquid like yesterday. Sometimes your strikes will be liquid. Sometimes you will have $5 strike price increments, sometimes $10 strike price increments, depending on the stock you trade. So there is no standard rule that if the stock has moved by 5%, that's it, roll it, tweak it to a directional butterfly. You have to go ahead and simulate it, and that's why on the risk profile we have the compare tool, right? The compare spread tool, where now you can assess and conclude, yes, time to do it or not. Okay, cool. Siderman, should we be checking First Solar every day on our own? Yes, absolutely, Siderman. You guys have the tools and you have the trade on your account, so you should. Okay, you should do it. And the way I've done it is the way to do it. So you could do that. Thank you, Mario. Hey, Joanne, good to see you. No worries. Good, you're here with us. Wonderful. Okay, so let's continue with Intel. Really, there is very little to be said. Okay, Intel, remember, is the same story. We put this trade in place, out of a reaction of that UFO and the speed bump, and we are in a trade that only has $4 of risk. Our final target is shooting for all the way this red UFO, and we're just going to wait patiently for something significant to happen before we do anything with that call, because we are owning, if you recall, we are owning the 57.5 call, being 57.5, almost where the target is. So this is an out of the money call, and if the stock doesn't move at least a bunch towards that call will not gain enough value to do nothing with it. Good news is that the most we can lose on this trade is $9. So it's almost a free trade. This trade, if you sum up everything, is performing $30.5 net, even though on the TOS platform it shows as -10, because it doesn't account for the trades, for the contracts we already closed. But if you add it all up together, it's $30 of profit. So trade is doing well. You're risking 9, you're making 30 so far. Let's see if the market does another push with Intel, and then we can talk about it. So probably next week, again, assuming Intel has moved higher, we may have something to do. Also, next week may be good timing, because if you recall, again, looking at the S&P, okay, it's always good to kind of have this mindset of anticipating without getting biased. But remember, if the S&P was to start falling, we expect it to fall for a couple of days and then get back to blue. So it's not like we expect a major crash. So, maybe that's happening tomorrow and Monday, and then Tuesday, Wednesday, market is back going higher. And then when we meet on Wednesday, it's a great day to act on the Intel trade, but not at the moment, okay? And lastly, the ADM trade is losing $19. So yesterday, when we entered this hedging trade, we were looking at this time frame, okay? And price, was it this time frame? No, it was the 55-minute time frame, correct? So price came in here. If I rewind a little bit, okay? So that was yesterday, I believe. Was it here? I am not sure now. Something like that. Well, to be honest, I'm not sure now. It's here we go. I guess it was there. Right there. That was the picture that we had. So exactly, now I remember. So the market came in. Okay, this was right after we concluded our session, after talking about the pioneers. You guys remember? And I remember getting filled just a little bit after. And from there, we were expecting the market to fall. Okay, but and it started falling. Okay, so the normal thing started happening. But today, as the market opened, major change of movement in the opposite direction, and this happened. Okay, so we are again in this trade. It's a hedge. Again, there's not a major concern. To be honest, the climate is still red. This stock belongs to a group which is a weak group. So if the market pushes down at some point, we should get to see that stock fall down very, very fast. Something like that could happen any moment. Okay, so we have it in the account. This is protecting our deltas. This is very visual now, Maka. I remember yesterday you asked me, but here you can see it very well, how Intel is providing 18 delta positive, First Solar 55 delta positive, and you can see how ADM provides those negative 34. So overall, my net portfolio is net positive delta. So if the market goes higher, I'm going to be happy, even though that means ADM is going to lose, because overall I'm going to make money. Okay, so we are exposed, but we definitely added some protection against all the positive deltas that we would have. We would have like around 70 delta if we didn't enter that short. Anyway, so I took a little bit much time than what I thought when it comes to reviewing the trades. So let's keep going, guys. And I want to get now into planning new trades. And I want to kill two birds in one stone, which is looking for a new trade, but also talking a bit more about the matrix and how to scan for things. Okay, how to scan for things. So first, I'm gonna take a look at Mario's question. He said, for a bearish strategy, we got scan number 1, top negative CIV spread. That's what I have from yesterday. Scan number 2, CIV put range less than 20. So I said the other day, and I remember a few weeks ago I said otherwise, but because I sensed a little bit of confusion in the group, so, and it's not going to make a major difference. So I suggested to just use the mean, and that's it. So we don't need to think about the put or the call or whatever. So we just go for the mean. And therefore, I was using continuous implied volatility mean to be less than the 20 percentile. Okay. This is what I had selected here there. So instead of the put range, it was the mean. Okay. Now, if now I understand what you meant there, Mario. Sorry, I misunderstood for a moment. So then, let's say you didn't have trades by doing that. So you can always, instead of using CIV mean minus 20, you can always use CIV mean minus historic volatility below 2 standard deviation. Okay, that's another possibility on how to do it. And another possibility on how to do it, if you're looking for very cheap options, okay, it's a CIV mean greatest decrease in the last 5 days. So those are the 3 choices when looking for low volatility: greatest decrease, below the 2 standard deviation, or below the 20 percentile. Those are the 3 choices that we go for when looking for cheap options. And the fact that you selected negative CIV spread, that makes you bearish. This has nothing to do with cheap or expensive options. This is giving you a directional bias coming from the derivative markets. Okay, and then once you got those scan 1 and 2 in place, then that's when you play with the filters. Okay, that's when you play with the filters, where, yesterday I was looking for strong down markets when it comes to the group. Okay, and also I had a condition based on auto climate, where I was looking for auto climates that were down in the daily time frame, sensible, so the market has not felt that much. Okay, I have a wrong position size. I am negative delta. You mean, Maka, you mean your overall portfolio, or you mean the trade from yesterday? Because the trade from yesterday is negative delta. Okay, the ADM trade is negative 34. So if you have negative delta on that position, you are doing the right thing. Okay, now my portfolio is made of 3 trades, and the overall delta for the portfolio overall, okay, it's positive. Overall delta, yes, overall. Okay, and Maka, do you have the First Solar and the Intel as well? Okay, maybe I can expand this so you see what my trades are made of. Maybe you can take a screenshot and then you can review. But basically, the ADM is made of buying the 60 put and selling the 55 put. The First Solar is made of buying the 92.5 call and selling the 115 call. And the Intel is just a long call using the 57.5 strike. You have no Intel. Okay, so what else do you have? Do you have, because I know you missed a few sessions, so I don't know if you have First Solar or you have other trades, Maka. These may be trades that you found on your own. So when you said you have the wrong position size and you are negative delta, I don't know if you mean that you did the same thing I led you to do and you have a different delta, which means probably you used an option backwards. You bought an option instead of selling an option or something like that. Or you mean that maybe you have other trades and your net result is negative delta, which then it means you have a different portfolio than mine. You have First Solar and ADM. Okay, so First Solar got a delta of 55. Okay, so 55 minus 34, that is still positive. You should be positive 20 delta. So if you're not positive 20 delta, I would guess that something's different. You use different options or something like that. Okay, so again, hopefully you go ahead and take a screenshot if you haven't yet, so I can continue the session. And I would like you to review these, and for sure feel free to comment later on. You have different contract size. Okay, so instead of 1-1 and 1-1, maybe you have 2-3 or 3-4 or whatever it is. So yeah, of course that's going to impact the delta as well. Okay, so yeah, okay, cool. So let's continue. Good. So we are going to be looking for an iron condor now. Okay, guys. So I want to uncheck everything. Okay, just so I start from 0. Okay, I uncheck everything. Here we go. Everything is unchecked. So I start from 0. Okay, and we are going to put together this iron condor, and as I put it together, I'm going to take advantage to kind of re-explain some of the things of the matrix, because you guys asked me to do that. Many of you started using top, and you are doing your research, your own practice, and when you get to the matrix, of course, what's the matrix is amazing, but precisely because it's amazing, it's also confusing because there are so many options that you could get lost into so many things, right? So let me lead you and guide you a little bit into the rationale on when I'm looking for a trade, putting on the side that you guys can find your own processes and rules and other ways to approach it, and it's not necessarily wrong. But again, let me lead you into my approach, the approach I use in the sessions. Okay, so first of all, if I'm looking for directional trades, I like to come here to the advanced option scan, and as Mario suggested, point at my negative or positive CIV spread. Okay, so again, if I'm directional, the first thing I'm going to do with the options is try to pick some directional something from the options. Okay, but it's not the case. Okay, in this case, I'm looking for an iron condor, so I'm not going to look at any of these because I am not directional. An iron condor is the complete opposite. Okay, now when I do an iron condor, what do I need? Well, when I do an iron condor, I need the options to be as expensive as possible to create as much credit as possible in my trade, providing the best results as possible. So my first attempt is going to be to use mean greater than 80. If this doesn't work because I don't get good stocks, or I don't get symbols, or I get very few only, so then my second attempt is going to be to use CIV mean minus historic volatility above. Okay, and my third attempt, okay, in this sequence, if this doesn't work, then I will look for top percentage increase in the last 5 days. Okay, so again, I'll repeat one more time. This is recorded, but I'll repeat. So step 1, CIV mean greater than 80. This is what I'm going to select now. If I don't find anything good here, then I will go for CIV mean minus historic volatility above 2 standard deviation. Step number 3, greatest increase in the CIV mean in the last 5 days. So those are the 3 ways, the 3 different methods, just as valid, just as logical, even though the rationale behind them is different, but 3 methods that are likely going to find me options that are nicely have hefty premium. Okay, so I'll start with 80. Okay, so when I do that, a list is loading here. Okay, it's not a very good starting point. I only have 3, so that's not the best. Okay, but anyway, let's continue. Second thing I want to do, since I'm doing an iron condor, looking for iron condors, I don't care about groups and rotations and anything like that because I'm not directional. Options filters, that's not going to work because options filters is to filter options contracts. I'm not scanning for options contracts. I could scan for options contracts if I select that option, but I'm not scanning for options contracts. I'm scanning for continuous implied volatility. Continuous, okay? Implied volatility means that you're looking at multiple options from a stock. Therefore, I'm scanning for stocks, not for options, okay? So that options filter is grayed out automatically because, I didn't select options. Step 3 is my scan list, okay? As you guys know, I always use the penny increment options list. Many of you asked me to email it to you, and I did. If you haven't yet or you want it, just email me and I will send that list to you so you can import. You don't need to use that list, but I guess you understand the benefits of using it, which is that those options trade in pennies. So when it comes to negotiating the spread, you can get as precise as 0.001. So that's good. Okay, now there are other options in the market that are very liquid and their spread is going to be 0.05, for example, a nickel instead of a penny. So you don't need to use my list. But again, that's what I do. And, it's something that simplifies the process a bit. Okay, so I'm adding the scan list here. What else am I going to do? I'm going to be looking at this tab with Elliott wave turning points. Even though I'm not looking for a turning points now, that is indeed valid if you are directional, which, we'll talk about that. But I will be looking at the strength levels, and I will require the daily strength and the weekly strength to be neutral. Okay? When I do that, this will help me to find stocks that are range bound. And not only that, in different time frames, meaning that they are likely to remain range bound. Of course, we need to look at the UFOs and everything else. But from the scanning point of view, I want to add those odds in my favor, okay? What else am I going to do? I'm going to look at earnings, okay? And I want my earnings to not to be too close. So I'm going to exclude stocks that report earnings in, let's say, less than 5 days, okay? So if those stocks report earnings too soon, forget about it. You can even get more precise. You can say, look, if the earnings start, anywhere between now and next Friday, I'll point at Saturday. So I just don't want to trade them, okay? And so you could do that. But anyway, this is it's a bit quicker to just select the amount of days, and it's kind of good enough. Stock price range, we are not going to use that. That tab is not useful for this type of trade. And then the auto climate, again, this is very useful to be directional, but we are planning on a non-directional trade, so it is not providing an extra advantage at this moment in time when you are purely non-directional, and therefore that would be it. Okay, so I just went from top and then from top to bottom and then from left to right through the options I would like to select on the matrix, and then I click scan, and now let's see, we got one stock. Okay, so this is the one stock that shows up in that first attempt. I'm going to look at the chart, but before I do, since we are talking about the matrix and you guys asked me, I want to comment on a couple of things related to the matrix, which is number one, what if you got none? Or what if you look at Newmont Corporation and it doesn't work, right? And you need more opportunities. So ways to find more opportunities are two. First, as I said before, change the CIV mean greater than 80 to be CIV mean minus historic volatility above 2 standard deviation. And this may create a different list, which may have more symbols or may have less symbols, in this case less. You can also look at advanced option scans and look at greatest increase in the last 5 days, and these may create a list with more symbols or less. In this case, 2 new symbols. Okay, so you see, we have ways to, still being very picky, find stocks with extreme conditions of volatility. Okay, and then what if those stocks, none of those are giving you anything good? So then you can also play with the strength levels instead of going from a daily neutral to a weekly neutral. So you can play from, what if you do 2-day neutral to weekly neutral? Or what if you do 3-day neutral to 2-day neutral? Or what if you do 3-day to 1 day? What if you do 1 day to 2 day? And you can just keep playing with the strength in different time frames. Of course, in a perfect world, you do daily and weekly, because it's kind of this is kind of telling you that the stock is kind of like in this boring mode, not only in the lower in the daily time frame, which is the shortest in this case, but also all the way to the weekly. So that increases the probability of the stock to remain range bound for a longer time. But again, if you don't find opportunities, okay, it's definitely something you can test, because ultimately you will look at the chart, you will look at the UFOs, and this is what will in the end help you accept or discard the trade. So those are the two places when doing non-directional trades that you will act. Once you have your main filters set up, you would then play with the strength and play with the implied volatility. And with those tweaks, you would basically keep increasing the list of symbols, which normally will not be that long, especially when the VIX is low, the VIX has been dropping and things like that, which is the case. Okay, but that way at least you keep yourself in that picky mode, only looking for quality trades. Okay, and by tweaking all of that, I mean it's quite difficult to in the end up with no trade for the day. Okay, so almost every day you will find trades way faster, way more efficient than with what we used to do with TradeStation. Nothing wrong with the process we used to perform, but with this normally you will find more trades. Okay, having said that, there may be days where you have no trade, and their patience comes into place, and a professional approach to trading is indeed required. And if you have to sit on your hands, my friends, this is trading, because trading when you have low odds, it's silly. So we only trade when we have the odds. Okay, cool. Guys, give me a little bit of feedback. You guys asked me to review a little bit on the matrix. I just did it for non-directional trades. We will do the same for directional. But now I need to move into planning a trade. Okay, so everybody with me, do you need me to repeat anything related to the matrix, or are we good to continue? Okay, and also extra question. I'm sure the first time I got the matrix on the screen and I showed you, filters like that, and you would be like, "Oh my God, what do I do now?" Right? And probably it felt a bit intimidating. But I would think, I would, assume or expect that now, after a few weeks of practice, and some of you playing with the platform at home already, uh, probably this is now little by little becoming second nature, and you are just a little bit more comfortable. Okay, so we should be okay. uh, Mario, 7 opportunities with the TS data feed. Well, to be honest, the matrix is running on the net, on the cloud, so it's not running locally speaking. So the fact that you have 7 opportunities may be because maybe you are, instead of stocks, you are looking stocks with ETFs. Maybe instead of 34, you got 5. So something must be different between you and I. Or maybe if I click scan, maybe a few more opportunities will show up. Now it's 3, because again, this is real time on the cloud. Okay, so it's not something that runs on your computer, so we should have the same. Okay. Siderman, very clear, need to practice a lot, of course, like everything, my friends. Mario, better and better. Great, thanks for sharing that, guys. So anyway, so let's go for it. Okay, and the way I like to work with my matrix is to float it, so I can go ahead and take it to another computer screen and click from there, so it doesn't distort my screen. So I'm going to go for the first symbol, which is WDC, Western Digital, and we're going to be moving to these particular time frames where I got my probability cone, and I also have that earnings indicator that shows you that earnings are on October 27. So we have plenty of time from now until then, and we can start planning on the trades. So now, how do we start planning on the trades? Well, there are many ways on how to approach it. One way on how to approach it is to begin with the charts and start drawing lines, start looking at the UFOs and see what's possible. Okay. Another way to approach it is to, for a moment, okay, and this is never do that, okay, but for a moment, you could go ahead and say, okay, forget about the UFOs. Okay, let's say UFOs never existed, right? Let's plan the trade only based on probabilities and forget about the world. So how can you do that? You can do that with a spread select, okay, which is what I'm going to do. So what I'm going to do is to kind of reverse engineer the Aaron Condor by planning it with a spread select, and from there going to the chart to see if my trade can be accepted or not. Okay. Of course, as you practice the method, practice will make you a bit quicker as well, because this is not the case with WDC. But what if the stock was making all-time high? Well, if the stock is making all-time high, forget about it. No need to spend time doing it, because you won't have red UFOs because it's making all-time high, right? But in this case, it's not the case. We have, the all-time high is 78. It's currently trading at 61. So, there will be UFOs above and below. It's kind of like a sure thing. Okay, so it is indeed a valid candidate for us to begin the practice, okay, with WDC. Okay, and therefore, let's begin. Okay, I'm going to have a sip of water if you don't mind. Cool. Okay, so first thing that we're going to do is to select the type of spread we want to build, which is a short Iron Condor. So this is what I select. Okay, so that's the first thing. Second, we need to work on the expiration dates. And of course, we saw the expiration date is all the way on October 27. So can you find an October something expiration date, like October 22nd, for example, here, 50 days from now? Yes, you could. And to be honest, anywhere before that date, it's fine for an Iron Condor. But at the same time, if you go too far in time, the time decay is going to be very slow. And then on the other hand, if you go too short in time, like for example, 8 days from now, so then the time decay is going to be very fast, but then you don't have opportunities really to tweak your trade. I mean, you do, but typically only one, which is convert the Iron Condor into an Iron Butterfly. That's all you can do. Because normally, if something bad happens to your trade and you're breaking the range, then you need to act on that, and that's it. Where if you use a longer term expiration, like 36 days or something like that, so what happens is that now, if the range is going to be very wide, and then if the trade is moving up or down and you need to do something about it, then you have opportunities to roll the puts higher, to roll the calls lower, and keep massaging the trade multiple times until, let's say, worst case, the range is broken and now you need to convert into an Condor. But all those initial massages have reduced the risk of the trade in a major way, and now you end up with extremely tiny losses if you lose, or even maybe, in an ideal world that doesn't happen that often, you may end up with a sure thing profit after multiple tweaks and rolls, which that almost never happens, but it does from time to time. Okay, so in other words, which date should you pick? Okay, so which date should you pick? Okay, and again, the other thing that I want you to keep in mind when it comes to which date to pick, it's also, where is the volatility? So I'm loading here a tool called the Skew Tool, and I'm going to be loading calls and puts. Okay, I'm looking at volatility. Okay, and we just said that all the way to October 22nd we are fine. So I'm just going to be loading multiple expiration dates by clicking on the color, and when I do that, okay, you would see that September 3, it's the highest implied volatility we can have. Okay, like 90% volatility. Okay, but why is that? Because this is next Friday, so this option expires next Friday. Okay, so if I remove next Friday, you can see that implied volatility is at different levels, but it seems to me that well, there is a very big exception here, and this is why we use a spread select tool, because all of those exceptions, if I can do a little bit of a mini lesson on volatility skew here. So almost always assume and try to plot what is known as a volatility smile, meaning that the implied volatility you have at the money, okay, that stock is trading at 61.69, so the at the money is the 62 strike. Okay, so the implied volatility you have at this level is 44%, right? And any strike that are below or above 62, they will tend to have more implied volatility, less vega, but more implied volatility. So don't get confused with that. Okay, so in other words, if I look at, I don't know, let's say 5 strikes above, which is 67, so then the implied volatility for that is going to be 46. And if I look at 5 strike below, which is going to be like 57, so the implied volatility is going to be, again, for 45, 46, which is more than 44, which is what you have at the money. So when you plot that, okay, and hopefully I'm not driving you crazy or speaking too fast, but when you plot that, you end up with the volatility smile, which, if I remove all these expiration dates and I only leave the one here, so it's a very clear smile, isn't it? It's a very, very clear smile. Both the calls and the puts are a smile. Okay, but then what happens? The reality is that then you load other expiration dates, for example, September 10, and when you look at the put ones, which is the dotted line. So look at the call. So the call has a smile like this. Okay, sorry for the bad drawing. But the put, instead of like this, which is what you would expect, right? So notice what just happened with that strike, okay, which is the 62.5 strike. That strike has a volatility of 54%, where based on the smile, it should be 46%. Crazy volatility. And why is that? No idea, but it's happening. Okay, why is that happening? Well, again, no idea, but probably some very large player just bought huge amount of 64.5 puts. And if many people buy the put prices will go up while the stock is not moving. So that translates into higher implied volatility, more premium to collect if you sell that strike. So in other words, when you load various expiration dates like that, like I've done before, okay, you get to see that there are, all of those divergences. Maybe I can load even more strikes, okay, just to make it more fun. Okay, here we go. So now if I look into this carefully, okay, so here we go. Okay, so you can see how overall it's a smile, but there are some strikes that got plenty of premium that you will not expect, isn't it? You see what I mean? So in other words, when doing the Iron Condor, it's great. When doing any options trade, it's great to use the spread select, as you have seen me do, before and basically build 99 spreads as you've seen me done before. Why? Because that way, if any of those spreads is picking up one of those strikes, this will translate in a greater return on investment. So instead of having a rule that tells you just buy an option that gives you exactly 30 delta, buy an option that gives you exactly that amount of whatever, which is great, but that you assume that all options follow the model. I prefer to build random amount of spreads and then filter them out to keep only the best ones based on performance, which are going to be the ones that capture those weirdnesses available now. Okay, maybe 1 hour later, this is not available, and now it is. Okay, are you guys with me on this concept? You guys with me on that, or did I just drive you crazy? Now, while I'm waiting for your response, if you're with me on that, you can see that there is a bunch of implied options that have a similar implied volatility, especially close to the money strike. But then you can see how the red one is more expensive, followed by the blue one, followed by the green one, and you can see how the pink one and the dark blue are way cheaper, including the light blue. So October 8, October 15, and October 1, those are 3 expiration dates that, visually speaking, were the lowest, where the ones I have on the screen that I have less with, which is September 24, September 17, September 10, okay, those expiration dates seem to provide more implied volatility than the other ones. And October 22nd, but that one is too far, so I'm going to leave it alone. Okay, so in other words, I'm going to be looking for an iron condor with September 24, September 17, and September 10. Okay, this is what I'm going to do with the spread select. So September 24, September 17, and September 10. Those are the 3 expiration dates I'm going to use, because if I manage to do an iron condor with those 3 expressions, I will likely get the greatest amount of premium as possible out of all the available expiration dates before earnings for that stock. Okay, so I'm going to be using that tool, the option Skew Tool, to identify that particular scenario. Okay, I'm just looking at your comments there. Maka, yes, great, makes sense, very clear now. Very sneaky. That's the option spy. Maka, very accurate. Okay. Well, JB is also my initials, which is also the initials of Mr. James Bond 007, License to Kill. So I don't know. Maybe you're right with spy. I love James Bond, by the way. Anyway, so getting back into options trading here. So I selected the spread type to be short iron condor. I selected the expirations to be September 10, 17, 24, because visually on the Skew tool, they look to be the highest ones, okay? So I'm going for the highest amount of premium as possible overall, and then look at that, the weirdness in a positive way, right? Because weird could be a bad thing. In this case, weird is a good thing. The weirdness of those unique option strikes. And then we're gonna do this with the spread select, direction both up and down. So we have build iron condor above and below current price, with a minimum range available of 0.5, but let's start with 1, because typically 0.5 would have you use many contracts. And the maximum range, that stock is $61.76 dollars per share. So I would say that, I'm okay up to $500. Let's try, but I would indeed prefer that trade to have less risk given how cheap the stock is. Okay, but let's begin with $5 to see what's possible. And with all of this on my settings, okay, by the way, as I said before, the minimum range and the maximum range refers to the distance between strikes. So if I sell the 61, the next one is 60. That's $1 difference. That's the minimum range, which has to do with your risk, right? When you do an iron condor, the difference between the put strikes and the call strikes above, these differences set the risk, isn't it? So the minimum risk for the trade would be $100. The maximum risk for the trade would be 500 minus the credit collected, whatever it is. And with those parameters in place, I'm going to build 99 iron condors, click update. So everything refreshes, Okay, and now I have all the iron condors here, which is, would be crazy to assess that manually. And now what we're gonna do is to go ahead and select an options filter, which, by the way, some of you also asked me to email you those templates, and I did. If you haven't and you want it, just email me, and you can now go ahead and select the iron condor preferred parameters template. And this is quite demanding from a start, but I'm gonna start demanding and click OK and see if everything fails or there are some trades that pass. And look at that, I got a bunch of trades that pass, okay, with my initial filters, okay, and therefore it is time for me now to look a bit deeper into what's possible. Okay, so first of all, when it comes to September 10, here on the top, you can see that I got break even 64, 65, 66, break even 57, 57, 57. So again, first question is a break even for the Condor of, to be able to trade a range between 66 to 57, something like that. Is that wide enough as a range or not using September 10? So the answer is on the chart. Okay, let me float this. Let's go back to the chart. And again, by looking at September 10, which is right here, so the top of the range here is 67. Okay, even without looking at the UFOs, statistics suggest that that market may reach 67 from now until September 10. And here, the P&L we get is valid, but we need the trade to remain below 64, 66, which is less than 67. So it doesn't pass. Okay, so that's what I meant before, that I'm just planning the iron condor based on the probabilities, and then I will look if the probabilities are good enough. Then I will look at the UFOs to confirm the range is valid. So it's kind of 3 steps: build the condor, check the filter passes and your break-evens, and with the break-evens above and below, which is the top and the bottom part of the range, then you get into the chart to check that the probability cone is giving you permission to do that. In this case, it's not, because again, the top of the cone, September 10, is 67, where the break-even is less than that. Okay, it's 65, 66, it's less than 67, so we cannot accept. But let's say we did accept it, so then you will want to move into a lower time frame and find the UFOs, because in the end, the probability cone is really cool, but it's just a mathematical calculation. We need those UFOs on top of the probability calculation, isn't it? So again, it's multiple steps to validate the iron condor. So with September 10, it just doesn't work. So what I'm going to do is just remove September 10, okay, update, okay, and go ahead. Okay, and this sometimes takes just a little bit of time because there are many calculations taking place. So I'm just going to type 99 one more time, and then I'm just going to resort the filter and now focus on September 17 and see if September 17 is giving us permission or not, or what. Okay, in the meantime, I see a question there from Mario. So it was there, how do you consider the target date? The target date, in this case, it doesn't matter, because it comes by default there based on the expiration days that you selected. And then it remembers that earlier I selected September 10, so it's there. But it doesn't matter, because for my iron condor, when I look at the performance later, okay, assuming this trade will pass, I'm going to be looking at the column P&L on expiration. I will not look at the column P&L on target, because there is no target for the iron condor. Okay, actually the target is the stock stays where it is, same price. Okay, so in other words, we only use targets for directional trades. So whatever value you have in there will impact the value on the P&L target date column, but we are not going to look at this column. We will look at the P&L at expiration in the case of non-directional trades, because again, non-directional trades have no targets. Okay, wonderful, good question, love it. So now we are looking at September 17, and now we are talking about a range all the way from 67, 69, 68, 67, 65, 68. So it seems that 68, 69 is the maximum for September 17. So let's move into September 17, which is here, and see how high this goes. And this goes to 69. Okay, so it feels a little tight. Okay, it feels a little tight. I don't think this is going to work well. Okay, so I'm going to give it one last chance for this trade then, which is to only use September 24. In the end, it seems that only one possibility is what we have there. So I'm just gonna resort. Now we have this opportunity is valid. It's all September 24, and now we are talking about 73, 72, 71. Okay, so 73, 72, it's kind of the top, and we are looking at September 24, which is right here, and September 24 on the top here it's 70, and on the bottom is 52. So on the top we got 70 plus, that's fine. But then on the bottom, we got 55, 55, 55, 55. We don't have 52, okay? So again, talking about that uniqueness, that weirdness of some strike that got more premium. So it seems that, the location of those strikes make it, whereas there is a little bit of a privilege or benefit to the upper part of the range, but a little bit of a penalty in the bottom part. And therefore, the lowest we can go when it comes to profitability is 55, where we need it to be 52. So we cannot accept WDC. Okay, we cannot accept it. It's not giving us what we need. Okay, so we're gonna move to the other one, which is Merck. So I just clicked on Merck. Chart is loading here with Merck. Okay, and we are going to restart assessing this trade from the same point of view. Okay, so I'm going to be looking at earnings, which are happening here on October plus. I'm going to be looking at the skew. And this, when you get used to these processes, is going to be quite fast. Okay, little by little, I'm just adding more tools, and therefore I need time to explain it. But it's going to be quite fast. Okay, so what I'm going to do is just load all those colors. I'm just skipping September 3, which is next weekend, and I'm just loading all those different colors to see which of those seem to be the highest one. And it seems that the red, the green, and the light blue, September 10, September 17, September 24, coincide, just like the prior case, happen to be the 3 expiration dates that were higher in that graph. Okay, so September 10, September 17, September 24. Okay, red, blue, and green. So with that in mind, let's get into the spread select. Oh, I just realized we hit the top of the hour. So let's see if we can complete this one. We are going to select September 10, September 17, September 24. Okay, just like before. Okay, update. Now when I do that, okay, we are going to be looking at the minimum range. So same as before, is minimum is 1. That stock is $76 per share. So we'll do the same up to 500. I would indeed not surpass 500. I would even feel 500 is a little bit of an extreme. And with that in mind, we are now ready to build 99 spreads. Okay, 99 spreads. And we're going to fill them out. Oh, I got the filter in place already. It says here, Iron Condor preferred. So let's sort and see if we get trades that pass. And we got one that passes using September 24. And this trade provides a range from 78 all the way to 73. Doesn't seem too wide to me, to be honest. Let's take a look at the chart with September 24, where this would be 81. Okay, 81 would be the range. Okay, and here the maximum we get is 78. So it doesn't work. Okay, so it doesn't work. And yeah, so again, a consequence of the VIX going down is that premiums overall are shrinking, and therefore we are not finding iron condors, even scanning the way we have, adding all that uniqueness that provided enough premium for us to accept. Okay. So we'll keep working on that, my friends, okay, in the following session, because we hit the top of the hour. But hopefully today also give you a bit more guidance into how you can practice yourself during the week. So hopefully as well next week, you come to the session with a few questions. Feel free to email as well if you have questions, okay, even though there may be times where some of your questions really, they can be answered so much more easily, when we are live here. So, I may suggest that in some of my email responses, depending on the nature of your question. So, but you decide, okay? You either wait for next week and you ask me then, or you send an email. Anything will be more than welcome from my end. I'm, delighted to see you guys working with the platform into place, okay? So keep doing that and count on me, count on us. And as you practice and you have questions, let me know. Again, hopefully today, please share with me. Hopefully today was giving you a bit more guidance into certain things, and it's all clear. You are not clear on range selection, Maka. When you mean range selection, you mean on the spread select or on the chart? Let me see. Ahmed, Jose, you compare with day chart. We used to compare with 55. No, I'm just using the day chart to look at my probability cone. Okay. The probability cone, by the way, is a tool that only works on the daily time frame. Okay. If you change to 55-minute time frame, it doesn't show. Okay. If you go to any time frame, it doesn't show. It only shows in daily. And the reason why is because, that way you can compare that with the earnings indicator, which also works on daily. Okay. So that's why. So I'm just looking at this calculation that projects my range. So I get a measure of, what's the price? In this case, 80.83. And now, if that was going to be good enough, okay, meaning, let's say on the, let me write it down so this is clear. Let's say on the spread select, okay, you have the break even up is, let's say, 85, and you have the break even down, let's say, is 70. Okay, so if that was the case, okay, and now you look at here at this value, and that value is like 81, but your break even is 85. So that gives you permission to go, right? So what I will do now is I will take this purple line, draw it here, and then on the 55-minute time frame, look for UFOs there. Okay, knowing that this is the statistical range, but I'm not doing it like the way we used to do with TradeStation, which is only based on implied volatility. We're doing it here with our probability cone because it's looking at multiple different types of historic and implied volatility. So we get the best and the worst case scenario. That's what we get, the best and the worst case scenario. So it makes us a bit more precise and a bit more careful with those trades. Okay, so that's why I did that, Ahmed. Maka, both when you compare and make a decision. If probability cone is higher and break even lower, we are within the range. No, but you want the break even to be above and below the range, right? Because break even means, okay? So break even means if your break even is, I'm just gonna pick 81 and I'm just gonna pick 72, okay? So if your break even is 81 and 72, it means you need the stock to remain in that box. Oh, sorry for that. You need the stock to remain in that box for you to profit. So in other words, below that point, you profit. Above that point, you profit. But beyond this point, you lose. And beyond that point, you lose. So that makes this to be your break-even point up. And that makes this to be your break-even point down. Okay? So what I want to see is I want to see break-evens that are within the values set by the probability cone. If my break-evens are within, using the same expiration date, okay, which is the vertical line pointing at a specific date. So if my break-evens are within the cone, then we are fine. If my break-evens are beyond the cone, okay, what did I just say? Sorry guys, I'm saying it backwards. Sorry for that. I just said it backwards. Let me rewind. Sorry, this sometimes happens. I get you confused because I somehow got confused myself saying it. Let me rephrase it. So if your break even is above the cone for a specific date, which is that date, and your break even below is beyond the cone for a specific date, which is that expiration date, then you're fine because the probability cone tells you that from current date to that date, the stock is likely going to stay within the cone, which is the blue area I just made a square, right? So if your break even is above and below that, it means that even if the stock was to surpass what the statistics suggest and the stock keeps falling lower, or the stock surpasses what the statistics suggest and the stock keeps rolling higher, okay? So then, you are still okay. You are still profiting. You start losing when you are above, or you start losing when you are below. Okay, that's the issue. So in other words, you want your break-evens, okay, to be uh, higher than what the cone suggests and lower than what the cone suggests. Okay, so that way you have this extra wiggle room. And in this case, we didn't have that. We had the opposite. Okay, so then the trade was not to be approved. And I'm sorry if I confused you when I said it before. Maybe I said it backwards. I'm not sure now, but definitely when I gave you the explanation on the chart now, I did say it backwards. Okay, I apologize for that, but hopefully with that second attempt, now it's clarified. Okay. Yeah, correct, Maka. So hopefully now it's clear. Yes, Ahmed, and we used to use the 55-minute chart for the UFOs, which we are going to do that too. That will not change. You have two ways to build the Iron Condor. Set the range with the UFOs and then go check if the Condor works, or set the Condor with the spread select, which we didn't have before, and then go find out if UFOs are available where you need them to be. Okay, so the second method is going to be faster for us to plan trades. But both methods are adequate. If you prefer to go the same sequence we used to do before, it's fine. It's just that before we didn't have the spread select. So I had to build the range first and then check the options trade to see if it passes or not. Now we have the spread select. So I can build 99 trades, find the weird ones that are the ones providing the greatest advantage, see what is their break-even points. So now I know my worst case scenario from a break-even point of view. And now that I know that, I'm just going to look for the probability cone and the UFOs that give me permission to take the trade. So I will end up moving into the 55-minute time frame and indeed using the UFOs, two above, two below. The same rules apply. It's just that today I didn't have this opportunity because the break-even points, were within the probability cone instead of beyond the probability cone. Okay. Hopefully this clarifies now. Yeah, Maka, you had it backwards because at some point in the explanation I said it backwards. Okay, so I'm sorry about that. I guess that we are human. Maybe I'm not that good as a spy. Siderman, Merck implied volatility is only 20.38 NTS. Yes, but again, while it's only that amount. So if we look at the matrix, it's one of the stocks that increased the most in the last 5 days. So if you look at the implied volatility, it's 22%. But as you can see, it's been increasing in the last 5 days. Okay, it's one of the ones that increased the most. So it's not the best in the world, but it cannot be the best in the world because the VIX is going down, right? So that's the best we can find today, even though I didn't look at the other possibilities, which was CIV greater than 80, okay, or CIV above 2 standard deviation. I never had the chance because of lack of time, okay? But in any case, when the VIX is going down, you are not going to find unless something crazy is happening to that stock. And if something crazy is happening to the stock, then that stock will not be neutral and neutral. Probably the stock will be falling hard or rallying hard, and then you will find plenty of volatility. So here what we're trying to do is find the uniqueness, which is a stock that is not doing much while the volatility is the most that possible, and then see if that probability cone range allow us to take the trade when compared to the break-even points, assuming we got the UFOs. Because all of these together, I guess you are with me on the common sense, it's high probability, right? But of course, we need to do some research to get the yes, okay? Which in this case, the two symbols we checked, Western Digital and Merck, were a no. Thank you, Jose. Things are clear. Day by day. Thank you, Mario, so much. Thank you, Maka, as well. Ahmed, thanks. Clive, very good and clear. Great. Maka, I was fine. Okay, so then I feel a bit better now because for a moment I didn't know when is it that I said it wrongly. But I do believe that there was a time when I said it wrongly. So sorry for that. And yeah, got it. I read you as well, Sayo man. Cool, great, my friends. We're in the process. Okay, so if you recall, March 1st, earlier this year, we started adding a lot of complexity in options trading, complexity in the positive sense of the word, because complexity means more options, more possibilities. So we added doing all of that. And now from an option strategy point of view, you know things you didn't know before, like, tweaking the trades, rolling the trades, managing the trades during the life of the trade, converting trades into other trades, double diagonals, double calendars, so we've done so many things from a strategy point of view. Now what we're doing is that with new tools, top in this case, we're now learning to use the new tools, looking for processes that add odds, that save us time. And of course, all of this needs a little bit of time for us to master. But we're getting there, guys. We're getting there. And of course, since the last week, for the first time, you guys also have access to the tool, which is really what's going to make a difference. Because, if I'm the only one doing it, of course, you can still learn. But if you do it and then throughout the week you practice what I taught you, then next week you show up in the sessions with questions, this together with your practice, wait a month and you'll see how everything is so different. Okay, so keep up the good work, everybody. I love it. Keep going. Count on me, count on the team. Shoot emails if you need me. Shoot emails if you need us. And let's keep up the good work and see you next week. Okay, everyone? Thank you, guys. And thank you for the extra 15 minutes as well. Take care, everybody. See you next Wednesday. Bye-bye.